thank you guys for coming. Thank you, Daryl, for arranging this, and everyone at the meetup for helping out, helping us set up. My name is Jim Bruce, as you can see. In the fall of 2013, I released a film about the Federal Reserve. It was the first ever documentary about them. There have been some films that sort of touched on the Fed. Ours was definitely also the first to include Fed officials in the film itself. We were hoping to screen a few clips from that film, but we couldn't figure out the technical side of that tonight. But there's people like Paul Volcker and Janet Yellen speaking in the film, speaking openly about the Fed's successes at times and failures at other times. So I'm going to assume that everyone here is fairly interested in the Fed. Can we get a show of hands? How many people think Fed policy has a large impact on their own investment portfolio? All right, most people. How many people would like to get advance notice of when the Federal Reserve will raise interest rates next? Okay. Now, how many people know what will, and I'm right there with you. How many people know what the market will do when the Fed raises interest rates? All right, there's one guy. I want to talk to him after. He'll be the next speaker. So, to me, we're in a place right now where the Fed has occupied, and that's why I wanted to make the film about them. I feel like they've occupied this incredibly central role in our markets and our economy. But yet, at the same time, they're sort of engaged in this experiment. And I'm not convinced, and I don't think many people are convinced, that they really know exactly how it's going to wind up. I think sometimes, as investors, people get caught up when the Fed is sort of on a streak of boosting the markets along, as we've had in recent years. There's this sense that the Fed is controlling things, and they can make things happen how they would like to have happen. But I think in the film, we look at Fed history, and there's a lot of mistakes. There's a lot of times where the Fed loses control, where the Fed gives the wrong signal, and things kind of go the other way. So I think there's a lot to look out for. And what I'm going to do in my talk is kind of give you guys a survey of the landscape, try to give you a sense of what the Fed is thinking, why they're thinking that, and what some of the ramifications might be of Fed policy, especially in the months to come. And what I hope to do is leave enough time so that after I'm finished going through these slides and talking about things, you guys can ask me questions, and we can have sort of a discussion about what it all means. Because I think hopefully as I'm going through, you guys will be thinking about things, coming up with questions. So please store them for the end, and we'll circle back to do some Q&A. So my first thing I wanted to bring up, I think it's important for everyone to remember, no central bank has ever begun a program of quantitative easing and sort of ended it, normalized interest rates, and kind of come out the other side. There's been currencies throughout history that have sort of risen and fallen. Japan is the country that's kind of been doing the most quantitative easing. They've been doing it for almost 20 years now. And they've been interest rates at zero for almost 20 years. But they haven't kind of come out of it. They haven't figured the way out. So I think the Fed is hoping to find a path out of its current policy at 0%. But there is a real question as to whether they're going to be able to get out of it. Looking out at 2015, this is something I try to keep track in my head of what is the market expecting, what can we expect. I think right now the Fed, as Janet Yellen testified last week, is clearly on the path to hike sometime in 2015. I think there could be, there's a number of things you could imagine, a stock market correction or some further economic weakness like we saw earlier in the year. There are a number of things that could slow the Fed down. But I think if everything kind of keeps moving along for the next few months, the Fed may very well try to hike in September. I think more than anything, the Fed is looking at asset prices as an indicator of how their policy is working and whether they need to hit the gas or the brake. I think if stocks started to really blow off, the Fed would be more aggressive in raising interest rates. I think if stocks kind of trend sideways the way they are now, the Fed will try to tentatively raise interest rates. I think if stocks were to fall out of bed, we begin to see the Fed responding to that. I don't know how many people remember, in 2004, the Fed was raising interest rates up from 1%, and they did a quarter point at every single meeting for over 2 years to get back up over 5%. This is not 2004. So I think Janet Yellen made that clear recently. They're going to move tentatively, slowly, and I really doubt that they'll even raise interest rates at 2 meetings in a row unless things start to get really bubbly in the market. The other thing to keep in mind, I think the Fed is thinking about this, is economists like to say Fed policy acts with a lag of 12 to 18 months. And if you think about it, there's an election in November of 2016, and I think the Fed is mindful of not wanting to slow the economy down as we enter that election. I don't think they'd say that, but I think they are. Again, I think that was a decision. The Fed acted very slowly in 2004 to raise interest rates, and I believe that had to do with George Bush and his re-election campaign. So rate hikes have been just around the corner since 2009. It's remarkable when you go back and look at futures markets, where they were pricing the initial Fed interest rate hike. It was always a year or two out, even as soon as July of 2009, which was very close to the market bottom. The economy was still getting off its feet. People were pricing in a January 2010 hike because the idea of being at 0%, seemed so unusual at the time. And you can see every July since, the market has continually moved out this timing of a hike. But right now, markets are pricing in a likelihood of September or December. So we've gotten a lot closer to the actual liftoff point, as the Fed likes to put it. But the timing of the first hike, I did this in March. You look at March 18th to March 19th, there's a huge shift in what the market was expecting when they were expecting the next hike. It shifted to September, October, December, and away from, going into, and so this was a Fed meeting, March 18th. That's what can happen. The Fed can have one meeting, one press conference, and then the whole market can shift out. So clearly that's what's been happening. And I guess the big question is whether we'll keep on that path, or there'll be something that happens that pushes the Fed further down the road, or whether we'll actually go through with it this fall. Janet Yellen, as some of you may have noticed, testified before Congress last week, and I put together some of the key points that she really, more clearly than she's ever done, guided toward a hike this year. Sometime this year. It gives her a lot of room for September, October, December flexibility. And some of her reasoning that she expressed was that if the Fed waits until 2016, they may have to move more aggressively. One of the things the Fed, we mentioned Fed policy acting with a lag of a year or more. So one of the things, Fed officials, people in central banking fear the most is being behind the curve and having to catch up quickly. So if inflation or the stock market or something was to really start to take off, the Fed would rather have already moved a little bit than to wait till 2016 and then to actually start raising rates, very aggressively. So she said they'd rather have a slower pace and begin sooner. The other thing the Fed expects is a tight job market. I don't know if you guys any of you out there are looking for work or looking to hire people. I've noticed that as someone who's hiring people occasionally, the market is a lot tighter than it's been in a long time. They're expecting that to lead to wage growth. It hasn't really shown up in the statistics, but a lot of that is demographics. There's a lot more younger people. There's older people exiting the workforce who make a lot more, and there's a lot more younger people demographically entering the workforce who make a lot less. And so we're not seeing big wage growth numbers, but there may be a demographic reason for that. Another reason is slow productivity growth makes inflation more likely. So if the Fed thought we were going to have a really deflationary period, they might decide to hold off on rates because they want to wait for inflation to edge up a bit. But if for the last several years, and the Fed thinks of it as a secular thing at this point, I believe, productivity growth has been really slow, down around 1 or 0.5% a year. And when people aren't more productive, there's less supply being created, there's more of a chance of prices drifting upwards. I think the Fed is less concerned about a drop-off in inflation than they might be otherwise, given the numbers we're seeing today. The other thing I think is I think Fed officials have made it clear they're not too worried about Greece. They don't think Greece is a big deal for the U.S. economy, and I think they see Europe as a whole starting to heal and recover, and they see more upside from European economies. This cycle will be different. The Fed is, again, as I mentioned before, the Fed is not planning to hike continuously. So that's another reason. If they're, Janet's trying to make clear that, if we raise rates in September, that doesn't mean expect rates to be at 1 or 1.5% by the middle of next year, as they might have in prior cycles. The Fed has always had a series of hikes, and I think she's trying to make clear that they're gonna try one and see what happens, maybe try another, see what happens. So it's another reason to start now. Lastly, I don't think the strong dollar concerns the Fed as much as it did in March. The dollar had a really quick run coming into earlier this year. It was up 15-20%, the dollar index. And I think Fed officials did begin to talk down the dollar a little bit. I think it may have been one of the factors causing them to kind of do away with the possibility of a summer rate hike. But I think the dollar has kind of drifted sideways recently, and I think they're less concerned about dollar strength playing into earnings weakness, which is something we've seen. Stock earnings are down. All right, so possible complications. All right, let's say the Fed does want to raise interest rates. One of the issues here is there's $2.5 trillion in the banking system right now in excess reserves, so essentially just sitting there. So how can the Fed raise interest rates if there really isn't a lot of demand for money because the system's so flooded with it? So from a technical perspective, this is something the Fed's been doing a lot of thinking about, writing papers, studying things. They've been playing with different things in the markets already to test things out. And there's a little picture of the Death Star, which you guys may remember from Star Wars. So that is the name that bond traders have given to the technique that the Fed is going to use to try to raise interest rates with all that money floating out there, because they don't want to suck the money. Normally they withdraw reserves and with $2.5 trillion in reserves, they'd have to really take a lot of reserves out of the system in order to edge rates up. So what they're going to have to do this time is something called the overnight reverse repo facility. Bond traders call it the Death Star, and it's basically a strategy in which the Fed, through very short-term trades with banks, can actually suck out as much as $1 trillion overnight from financial markets in order to try to move. Because when the Fed is raising or lowering interest rates, they're doing it through the markets, through their open market desk. So they're not actually just setting a rate and everyone's following it. They're having to move and make trades in order to have that rate adjust. So a lot of Fed watchers think the Fed really will have to go over $1 trillion per day with this quote-unquote Death Star to suck money out of the system and allow interest rates to drift up. And a great quote from a Bloomberg article on it was, the likelihood that we're going to get through this without some form of accident is very small. So, again, we're in uncharted territory. No one's ever really done this before. So there's a lot of uncertainty. I think as investors, the message I would have is to be careful, to expect volatility in bond markets and stock markets, and to sort of have at least a somewhat defensive posture for the months and years to come. Another issue is bond market liquidity. There's been a lot of people talking about it on CNBC and articles written about it. JP Morgan did a study where they were looking at how much you had to sell in the treasury market, well, buy or sell, how much you had to trade in order to move the price of the bond you're trading. And they looked at, in February 2014, you could sell $280 million without moving prices. And then fast forward a year to February 2015, there's tapering's been going on, the Fed has been slowly tightening. Now you can only sell about $80 million in the market without starting to affect the price of the security that you're trying to sell. Another thing people are looking at is central bank holdings around the world have reduced bond inventory. The Fed's not the only central bank that's been buying a lot of stuff. That means there's less treasuries and other securities in the hands of traders than there might be otherwise. Dodd-Frank has also led to sort of a collapse, especially in corporate bonds, and dealer inventory. So the bond market is not the same bond market that we had years ago. In the film, that's one of the things I worried about, was the Fed really dominating markets in the way that they have. We don't really have as deep and liquid a market as we used to. And the question becomes, when they're trying these gigantic moves, how's that going to play out? Lastly, we're in the sort of late innings of a global search for yield. So I think the bond market is, we've seen actually, in the last few months, a rapid rise in a number of bond prices, big discounts on some closed-end bond funds. So I think we're already seeing some skittishness in the bond market. So that's another thing to worry about as the Fed moves towards tightening. Another thing that's pretty interesting that I saw recently is just the simple idea of institutional memory. The average Wall Street trader is actually quite young. So this was a study that I saw, I can't remember if it was Bloomberg or The Economist, but this is a share of traders who began working on Wall Street. 30% have been there less than 5 years. Take it up to 66%, less than 10 years. So people actually don't necessarily remember what a rate hike cycle is like. So it's a question of how will younger traders, because it is a young man's game, react to something they haven't really experienced before. As Daryl mentioned, I believe it's been right now about 9 years, might be a little over, since the last time the Fed conducted a single rate hike. So it really is quite a long time. Last but not least, retail investors have piled into unconstrained bond funds. I'm not sure if you guys have some holdings in there. I've dabbled a little bit, but it became very popular as yields got so low to try to find some other way to pick up a little extra money. That was an asset class that was, not very much in favor in 2009, and it's kind of exploded. There's ETFs, there's active bond funds, and the question is, they've been reaching for yield in kind of esoteric securities. What happens when there's a little ripple of fear in that market? It's a kind of a recipe for trouble. We've also had a lot of expansion in algorithmic or high frequency trading that really didn't exist 10 years ago. So what could go wrong? A lot of different things. Here's an example, October 15th, 2014. This was last fall. I'm not sure if people remember this, but no one really knows what caused it. But we had the second largest intraday move in the treasury market in 50 years. It was rates falling at that time. It could easily go the other way, but this is sort of what happens when you have, I'd like to think of the market right now in a lot of our different markets. It's kind of like a herd of cattle that it doesn't take a lot to spook people, and then you get a little bit of a stampede. So that's another thing to be concerned about as the Fed is trying to sort of change the message they've been sending, all these last years of encouraging people to take risk. Howard Marks, I'm not sure if you guys are familiar with him, but he's kind of a genius in the distressed bond trading world. I invest in a company that he runs, so full disclosure, I'm a fan of him. But he describes true liquidity as an asset that is easy to sell at a minimally discounted price if you're forced to sell. This is another thing to think about in terms of your personal holdings, is how sensitive are you to volatility? Because a lot of times people think of something as liquid as, well, if it's on the exchange, it's liquid, because I can always put an order in. But his question is, if things start moving quickly, what kind of price are you going to get? And he has a very important rule that things tend to be liquid when you don't need liquidity, which is probably more or less the last 5 or 6 years in most markets. But when you do need liquidity the most, it tends to be very hard to find. So again, it's something to think about with your portfolio. Is are you ready for a little bit of a liquidity shock should we have one? Some other things to think about. Some people say, well, why is the Federal Reserve raising interest rates right now? If you look at U6, which includes total unemployed, so people in any definition of unemployment, plus all marginally taxed workers and people employed part-time for economic reasons. If you look back at it, you'll see we're still well over, you have to go back to, the mid-90s to get to the level we're at today. So it's not like the economy is in great shape. I think a lot of people have that sense. So you could say, well, why is the Fed going to raise interest rates in a world like this? Another thing the Fed's always looking at is inflation. By some measures, if the U.S. measured core CPI the way Europe does, inflation would be down, close to half a percent, which the headline numbers people are reporting are higher than that. So again, you'd say with numbers like that, why is the Fed wanting to raise interest rates? When you look at core PCE, this is across a 50-year chart, so you see relative to history, not a great reason for the Fed to be fighting inflation. So the question is, given those conditions, why is the Fed even talking about raising interest rates right now? I'll suggest a few reasons. For one, we've had very fast job growth in the last few years. I think that's a big part of it. I think stock and bond market froth. I think the Fed. One of the things I talked to a lot of Fed officials about is how they weren't really paying attention during the last housing bubble, or closely enough during the 90s stock bubble. And so I think having lived through those things, the Fed does have more of a wariness to asset price booms than they used to. So I think they're thinking about stock prices when they're raising interest rates a lot more. They're talking about it now a lot more than they are thinking about inflation or even U6 unemployment. Another thing is Fed policy acts with a 12 to 18 month lag, so they're trying to project out if we have another year or more of economic growth. Their policy really won't start to take effect until then. So they have to kind of think in advance about where we're headed. But to me, the biggest reason they're talking about raising interest right now is they want out of the quantitative easing business. And as long as they're at zero, that's really the only recourse they have to fight economic weakness. So the Fed has models that try to predict, the impact of different rate moves, moving things 0.25% or, 0.5%. The Fed has been studying that for decades. But the Fed has not been studying quantitative easing for decades. And they really don't have a good understanding of how QE works. The Fed, that was one of the reasons, the Fed had 1% interest rates in the cycle in the early 2000s, was they were worried about getting stuck at zero. So they thought the faster we go to 1, the less likely we will get all the way down to 0 and not have any options. So I think the Fed really just wants to get off the zero bound and get out of the QE business. And to sort of illustrate that, I'm going to have, does anyone know who said this quote? So we don't understand fully how large-scale asset purchase programs, quantitative easing, work to ease financial market conditions. There's still a lot of debate. So any guess?
Bernanke.
Fed watchers here. Do you know? Close. This is Bill Dudley, New York Fed president. Okay, this is January 2014. We'll come back to that date in a second. Another quote. The problem with QE is that it works in practice, but it doesn't work in theory. There we go. Ben Bernanke. So again, January 2014. Now, there's a line from the trailer where he talked about being 100% confident of what he was doing in 2009. This is from a 60 Minutes interview, not my interview.
You have what degree of confidence in your ability to control this?
100%.
But so notice that in 2009 he was 100% confident as the world was kind of collapsing around him. But in January of 2014 he fully admits to not having really much of an idea about how quantitative easing works. So no coincidence, January 2014 was when the Fed began tapering, and they began getting out of the business of quantitative easing. It took them a while to wind down, and now I think they're eager to get some distance between themselves and 0%, so that the next round of economic weakness, the next economic cycle that comes along, they're not forced to get back into quantitative easing, because I think they're much more confident at knowing what happens to the economy when they move rates versus QE. Keep in mind, this is a great, remember we talked about October 2014, that big move in bonds. So this was that day. This is a chart, I think, of the Dow. Sorry, the print is pretty bad. But this is the Dow, and you can see it declining really sharply over the course of a few days going into that date. And this is St. Louis Fed President Jim Bullard saying, on this date, this is like a daily chart, we should be willing to remove some accommodation. So that was him saying, we might want to even, raise interest rate. He's really floating the Fed tightening. And then 5 days later, the stock market falls out of bed. Not much else happens.
When was this?
This was October 2014. This was last fall. And so then a few days later, he says the logical policy response at this juncture is to delay the end of QE. So in total flip-flop based on moves in the stock market. There was no significant economic data that came out during this period. So as much as the Fed is trying to get away from QE and trying to tighten and raise interest rates, I think they are going to be quick to respond to any weakness. And that's, to me, one of the differences with the Fed that we have today versus maybe 10 years ago under Greenspan, or especially 30 years ago under Volcker. They're a lot more flexible. They're open. The Fed likes to say data dependent. They're very open to changes. If the wind starts blowing the other way, we're going to go the other way. That's not the kind of words that you heard from the central bank before. Under Greenspan, it was, he tried to portray the sense of omniscience, and it's sort of like he was going to set rates how he wanted them. He wasn't saying, oh, I'm going to fine tune it and react to what the market's doing. So the Fed is communicating a lot more, and they're a lot less ideological. Those are probably all good things. But on the negative side, they're navigating totally uncharted territory. They're flying by the seat of their pants, and credibility in central banking is very easy to lose and very hard to gain back. That's an underlying aspect of the story of all sort of financial systems. It involves a lot of trust. And once you've built up trust, it's not that hard to maintain it. When you start to lose trust, it's very hard to get it back. So I think that's what the Fed is up against. One thing to think about in terms of where we are in the cycle is that everything is sort of relative. This being a different cycle, with the Fed being at 0% for so long, and using quantitative easing and things like that, some of the actions the Fed has been taking have had the effect of tightening and easing, and some of the things that have been happening in the world economy have had the effect of tightening and easing. So as the U.S. economy and payrolls improved rapidly over the last few years, delaying taper, I don't know if you guys remember that, in September of 2013, the Fed everyone expected them to do it then, and then they held off and the market rallied and said, oh, we got more quantitative easing. So that was a sort of relative easing, making that decision. Staying patient, keeping that in the FOMC statement for a long period of time, was relative easing in a context of rapid growth and rapid job creation. Waiting until December this year could be another round of that. If something happens, and the Fed decides not to begin to raise interest rates in September, markets again could say, oh, we got another few months of easy money. So in this context, there's different things that send signals to markets. And then on the other side of things, the global economy has been slowing down a lot in recent years. We're seeing, especially lately in China, but emerging markets, starting with the taper tantrum in mid-2013, got hit really hard. So that was a form of tightening, with Ben Bernanke warning and this shooting interest rates up in the U.S. a bit when he said we're going to taper, but especially emerging markets really blew out, and they've had a hard time since then. So that was a form of tightening. The dollar rally is a form of tightening. Economists like to say that a 20% rally in the dollar is equivalent to about a 1% hike in Fed funds. So we've already seen some things tightening the global economy that haven't necessarily hit the U.S. consumer, but they've been hitting U.S. corporations, and that's, you see profits in S&P 500 are down year over year. So you see profits kind of flatlining as if there's a recession approaching. So is that something, with the stage possibly set for a recession? Why again is the Fed talking about raising interest rates? To me right now, an important question to ask. A lot of people are very complacent about where we are in the credit cycle because they say, well, the Fed hasn't even raised rates yet. Recessions historically have come within 1 or 2, sometimes 3 years from the first rate hike. So people say, it's like it's the fifth inning. We've got to hike rates a bunch of times, and then only then, after that, will we get a recession. So we've got a lot of time before we have to worry about things. But if you think about it, economists like to call QE3 at its peak. I'm not as good with the math, but I've read some papers where they cite that as creating a Fed funds equivalent of -4%. So because they couldn't lower interest rates to -4%, that's why the Fed was conducting quantitative easing. They felt the economy needed an interest rate that low in order to grow. So tapering has really been, to me, the beginning of this tightening cycle. And I don't think we have as much time as some people like to think as we would in a traditional cycle, because the Fed has begun, they've been tightening modestly, because we're still at 0% over the last year or two. So I think things may happen a little faster this cycle because it's different from other cycles where the only way they were tightening was by raising rates. And then some people say, well, would the Fed raise rates just to lower them? So if as I think we may be, if we're late in the cycle, and later than we think, why would the Fed raise rates right now if that might mean a year from now they'd have to lower them back down? And the funny thing is that if you look at, since 1971, the average time between the end of a tightening cycle and the start of the next easing cycle is only 7 months. So historically, that is what the Fed actually is almost always doing, is they're a little bit behind the curve, and the economy is late in its cycle, and they're raising interest rates to prevent it from overheating. But by the time they're done raising interest rates, it's pretty much time to start lowering them again, which they tend to often do a little bit behind the curve as well. So again, something to think about. Can you just hold off? We're almost there, but I'll come back to you. Oh, sorry, yeah. So a quote from George Soros: "Every bubble has two components: an underlying trend that prevails in reality, and a misconception relating to that trend." So this is my way of thinking about the '90s stock bubble. There was a technological revolution happening. The internet was expanding really rapidly. There were a lot of new companies formed. A lot of them have been proven to be very successful. But then you add in this perception of Greenspan as the master who could control the economy. People at the time, we have quotes in the film, didn't think we'd ever have another business cycle. And it also happened to be the peak earning years for the baby boom generation, the largest in U.S. history. The assumption that people had was that the bull market would never end. And the collapse came when everybody was in, right? Everybody believed that. Everybody had to be in the market in 2000, and then sure enough, that was the end of the line. The 2002 to 7 private credit bubble, you have 1% Fed funds, you have all this newfangled engineering of derivatives and mortgage-backed securities with mezzanine tranches and all sorts of deluxe ways to get a AAA security. So you add that to baby boomer peak home ownership, which was a real thing. People buy houses and stay in them when they're a certain age. The assumption was that leverage and complexity, as long as it was AAA, everything was safe. And of course, we all remember what happened afterwards. 50-to-1 leverage at the major banks, meets a burst in mortgage delinquencies, and the whole system is headed to bankruptcy, in a course of a year. So the question is, where are we now? In my opinion, this is me getting more editorial. I think we're in a central planning bubble. I think we're in a, whereas these other things we're describing were behaviors in the private sector, what we have right now is public financial engineering. I mean, that's what quantitative easing is. That's what governments around the world have been borrowing money. Central banks around the world have been buying the paper. We've never done this before on the scale that we're doing it. The assumption is that you have to buy risky assets because central bankers won't let asset prices fall. They've got your back. There's a great clip from the film, which I can't play right now, but it's David Tepper. Are you guys familiar with David Tepper? He's Appaloosa hedge fund manager who, more than anyone, has been on top of this reflation trade since 2009. He was on CNBC. We have the clip in the film. It's a great moment where they said, "How'd you know in 2009? How'd you do it?" And he said the government gave me a put. He said the market could have gone a little bit. He's like, but not that much because the Fed would come in. So he really felt in 2009, when not many people did, that the Fed had his back and it was time to take risk. And he's been sort of saying one version of that or another ever since. And he's become one of the richest people in America while doing it. So it's been a very successful trade. But what I would do is play the clip and say, how many people are there left who haven't gotten the sense that the Fed has this market covered? I feel to me like it's very saturated, that idea that the Fed is in charge and they can control this and they have investors' backs. And what the Fed has been telling people since 2009 is to take risk, we've got your back. Take risk, we've got your back. And what we were talking about earlier is the Fed trying to shift modes and change that message. And the question is, and I don't know it, but is how will the market respond over time to that change in message? And I'm a little bit worried that quantitative easing worked because enough traders at the margin believed that it would. That's all. You don't need every trader in the market to believe that quantitative easing is going to push stock prices up. As long as the first few, bid things up, and then everyone kind of follows, and we get a momentum game going.
And that's a lot. We've been seeing momentum over the last 6 years behind this rise in asset prices. But what you've been seeing for the last year, kind of quietly, is the market losing momentum, losing breath, and drifting. Maybe we're around all-time highs, but we're not that much higher than we were, 6 months or 9 months ago. So I think it's time as an investor to think about protecting yourself. Lastly, monetary policy is 98% talk and only 2% action. So really, the Fed relies on saying things in order to get the markets to do something. And what you see in prior cycles is the Fed lowering interest rates didn't do anything to stop the collapse in stocks in 2001 and 2. They were ahead of the game a little bit historically. They were as quick as they've ever been to lower interest rates, and they did it really fast. But you'll see the Fed lowering interest rates in blue, and the market just continuing to tank in red. So sometimes words aren't really enough to get the market up. This is the financial crisis, basically. We go into it assuming Greenspan's the greatest central banker ever. That's what he was being called when he retired. And the Fed was, again, pretty quick. They actually cut rates for the first time before the stock market peak in 2007. But again, that wasn't enough to stop the market from really collapsing. So sometimes words aren't enough. In 2007, you probably saw the clip of Jim Cramer freaking out on his show and saying the Fed, they're nuts, they know nothing, and screaming and ranting. So that's one version of how people perceive the Fed when things are going wrong. And then when things are going right, you get magazine covers like this calling Ben Bernanke the hero, wondering why more people don't love him. But what we've been seeing is a re-leveraging around the world of global. There's this idea that we've been delevering for the last 5 or 6 years, but really that's only been in the private sector. The public sector, the total debt has grown very rapidly. This chart, from Bloomberg, was 2007 and 2013. We've seen almost twice the U.S. GDP in new debt around the world. Commercial real estate, which we may hear about later, is blowing out. And all this debt is being issued. But this is an interesting chart where it shows the net of new security issuance when you adjust for how much central banks are buying. And we've gotten right down to zero. We're issuing tons of debt, but the central banks around the world, whether it's Bank of Japan, Europe is doing quantitative easing, the US has been, have been kind of taking turns. We've been really buying all this paper, so it hasn't had a big effect on the market yet. So to me, there's a pattern of false assumptions. In 2002 and 6, the Fed thought, they knew they were levering the private sector, and the private sector was leveraging in response to their low interest rates. But they thought, Greenspan thought famously, that the market knew what it was doing, and that the big banks would unwind their leverage as long as the Fed very slowly and transparently raised interest rates. But what happened is, as the Fed actually slowly raised interest rates very openly and transparently, the banks took more risk, and they added leverage because they wanted to keep their profit margins where they were. So now the big question is the public sector is the one that's been levering and engineering things. And large corporations have been, I think, about doubled their debt in the years since the crisis. So the assumption is that they can unwind those groups, those players, can unwind and manage their leveraging as long as the Fed and other central banks around the world move slowly and transparently. But to me, I'm skeptical on that one. Since 2009, the big risk has been not holding risky assets. But I think it's based on an assumption that is false. It's the idea, and Tepper expressed it on CNBC, talking his own book, that the Fed can control the stock market and the bond market and economic growth and inflation and financial stability. But really the Fed, it can look like it's doing those things, but really if you look at history, they cannot, and they don't have the tools to control all those different variables. So as we start to see some of those things starting to wobble, I think that the assumption is going to be tested that the Fed really can control downturns, can stop every dip from turning into a correction. So the big question that I'll leave you with before I take your questions is how long until this assumption that the Fed can really control this whole thing gets tested, and that's where I think people have to prepare for a real different climate to what we've had for recent years. But so often people tend to extrapolate what we've had over the last year or two or three and expect that to continue. So with that, questions? I know it's a lot to digest.
You said at the beginning of your presentation that no government has ever been able to get out of quantitative easing. And wouldn't raising interest rates exacerbate the problem? Because then the cost of government borrowing.
Yeah.
So how do we get out of it?
So the question is, how, I noted in the beginning that no government has ever really gotten out of the situation we're currently in, and couldn't raising interest rates, its effect on government borrowing costs, couldn't that make the problem worse? And I think it could. And I think there's the risk that we've been in a big reflationary period with asset prices. There is a risk that ultimately the forces at play are deflationary. And that we haven't really, if you look at the rate of inflation, it hasn't really gone up anywhere in the world to where central banks would like it to be. And I think you could look at that as not for lack of trying on behalf of the central banks, that really is the forces at work in the economy, in the global economy, that having so much debt does create this sort of debt trap deflationary cycle. So I think that's something to be concerned about and to be, protecting yourself in some ways against.
How does the presidential election affect the rates?
How does the presidential election affect the rates? The Fed would never say it, but I feel like if you look at party lines, Republicans have been a lot harsher critics of the Fed. So Janet Yellen is sort of a lifelong Democrat. I don't know that she'll ever tell it to anybody, but I would think the Fed will be slower to tighten because of the election out there. If you look at 2004, again, I think an interesting geeky Fed story is that after George Bush the first lost his election in 1988, he had his interview on 2020, whatever channel it was, his big "you're not the president anymore" kind of interview, and he openly blamed Alan Greenspan for losing the election. He said, "I reappointed him and he disappointed me," and he very clearly laid the blame on Greenspan for not lowering rates before the 92, his re-election, when we did have a recession and the Fed was a little slower than he would have liked. So I think in 2004, one of Greenspan's reasons for being slow to fight the housing boom and correct his low rates then was the upcoming election. I don't think he wanted to be the guy that prevented another Bush. He was a lifelong Republican from getting elected. So I think it's there, but it's not something that anyone will ever discuss.
What might the first event look like in this new environment you just spoke of?
What might the first
event or occurrence, whatever?
That's
and in what market?
What's the spark? That's the thing.
Spark?
That's the part that to me is very hard to gauge. In the prior crisis, I was able as an investor to be ahead of it because I saw housing prices as the thing. And to me, knowing all the risky mortgages that were out there, housing prices going sideways was enough to unwind this whole game that was happening at that time with credit. But now the risk is kind of more broadly dispersed, so it's hard to say what that is. And to me the analogy is like 1987. I don't know how many people remember that, but that was a market crash. The largest in history. About 20. I don't know what the worst it was down, maybe over 20% in a week. So the sharpest correction ever. There was no real cause ever cited for it. There was an environment in which people had portfolio insurance, and they had these new strategies of selling futures when the market was down, and that created this just elevator ride for the markets. So that I think there were reasons for it, but there was never any there was some report about the German trade balance or something, that was like the only headline anyone could find that might have triggered it. So I feel like I think whatever happens next, it won't have such an obvious cause. But to me, one of the things I've read some pretty smart people talking about is the rise of ETFs. More people are in sort of passive vehicles. If you look at the junk bond market, there's a lot of people with junk bond ETFs. It's kind of a narrow market, but there's these ETFs that kind of have to own everything. It's kind of weak money owning it. So I feel like some of the vehicles that have become popular in recent years, similar to 1987, might be part of the cause. But I wish I knew what the trigger would be. I assume this cycle will turn like all cycles have. I can't tell what it'll be.
Thank you.
Yeah.
Okay, I'm going to be the stupid one in the room, but I'm having a hard time getting my mind around the definition for quantitative easing.
Yeah.
And also the statement that you made about the markets really want some level of inflation out there. Is that because of the profit structure? Is that what they're looking for that reason?
I mean, I think central bankers would like to have higher inflation because they're worried about how much debt that we have. And they're simply worried that the lower inflation is, the higher the value of debt. A much easier way to pay off debt, historically, has been when you have a lot of it. And we did it, the U.S. did it in the 40s and 50s, coming out of World War II. We had a huge amount of debt. We had very high inflation in the decades that followed, and that made the value of that debt shrink over time. But if you have low inflation, or if prices are even falling, then the value of, the burden of whatever debt is out there is higher. So central bankers want higher inflation. And in terms of quantitative easing, I mean, it's a silly word, but all that simply is central banks buying on the open market bonds. In the Fed's case, it's U.S. government bonds as well as mortgage-backed securities, in an effort to stimulate the market by sort of taking safer things out of the hands of the private sector and pushing people into other investments because there's literally less stuff available that's safe to buy, and pushing them out into risk. That's their theory on how quantitative easing works, is it kind of pushes investors into riskier assets because they literally can't, the prices drop, and also they can't, the prices rise for safe assets, and people also have less ability to stockpile.
So they want to stop doing that and get into the fluctuation of interest.
Yeah, exactly. They tapered quantitative easing, and so they have completely stopped now. And my thinking is that they're pretty eager to get into a world where if we do have economic weakness, they have the ability to lower interest rates. But right now, at zero, the only thing they can do to stimulate with their tools that they have is quantitative easing measures like that.
For a small investor, what do you think they should, small investors should take in the next to hedge against?
Yeah, so how can a small investor hedge? To me, I mean, there's the typical things. Diversification, emerging markets have had a much tougher time for the last few years, but they're a lot cheaper in some ways than U.S. assets, for example. So hedging in terms of values, watching your equity exposure. It's hard with bond prices, in some cases so historically high, to go deep into bonds, but there are some areas on weakness that you could move into, like municipal bond closed-end funds have gotten really hit pretty hard in recent weeks. So that's an area, on weakness. To me, when I adjust for my taxes, there's still a pretty decent yield out there, compared to a lot of other things. There's also some people would argue that cash right now, because your return on bonds and so many other things is so low, it's actually not a big price to pay for having a larger, portion of your holdings in cash as a defense, or cheap out of the money, puts or something like that, as a way of having a little bit of insurance. Try to buy it on strength. If the market, corrects a bit, then you can sell into that. So, it's a very, the funny thing is the Fed has created on purpose a difficult environment for small investors. They try to take away, if anyone could, if you could just get a 6% CD at the bank, that all of America would probably sign up for it. So they took that away. They want people to take more risk. But when you were early in that move, people like David Hubbard, you could capitalize on it. Now I feel like we're much more in the risk part of the game and much less in the reward part of that game. So you have to be careful. You have to be mindful of cycles, I think.
Okay, we have time for one or two more questions.
Okay.
You'll be here.
Yeah, I'll be
we're
here.
gonna have another talk for a couple minutes. You can speak to Jim during the break. Then we're gonna have a big break, so you can speak to him during the break.
Great, and I'll have some DVDs outside if people are interested in the
quick
film.
question.
Yep.
Very short. Pick two more.
Okay, 1 and 2. Yep.
Couldn't you have some of your some position in gold in order because there's always a danger of tremendous inflation bursting out since the central bankers want inflation. They want inflation. We're working hard to get it.
Yep.
You should have some edge, right?
Yeah. So the question is, should you have a position in gold, given how desperately, I think we can all admit, different central banks around the world. I mean, in Japan they've been really desperate. In Europe, I think they're becoming desperate to create inflation. So I think yes, I do have a small position. To me, the risk is that we were talking about earlier, with all this debt out there in the world, that is more. To me, the risk to gold is that there's more deflationary forces at work in the market in terms of all this debt that we have at the corporate, household, and government level in the entire developed world, and now also a lot of emerging economies. Like China's debt to GDP skyrocketed in the last 5 or 6 years. So that, to me, in the short term, could be inflationary. And if central banks ever figure out how to really generate rapid inflation, it could be highly inflationary. But in the meantime, to me, these debt forces have a deflationary effect. But I think, to me, historically, I think there is a reason to have a hedge of gold against, to me, the long run of what's going on. But I think in the short run, as we've seen, I think a lot of weakness in gold. A lot of it has followed emerging markets and commodities and other things. I think there's a risk of more of that continuing too.
If you could comment on the impact of the Greek crisis and how ultimately you think things might play out in Europe?
Yeah, it's funny. We had, the film was out a couple of years ago. We had a reference to Greece as being proof that even a nation isn't necessarily too big to fail if you have the wrong policies for a long enough time. To me, the amazing thing is that Greece has been in an unsustainable position for 15 years or something, for a really long time. And the markets recognized it with the initial round of the crisis in Greece in 2010 maybe. But their politicians haven't come up with a strategy for dealing with it. They've only found ways to make awful deals to borrow more money and things like that. So to me, the only way Greece has out of their situation is to default on the debt or debase their currency. But amazingly, I saw it recently. I thought, okay, with the recent crisis, now they're going to get out. But I saw their resigned finance minister, Varoufakis, I'm not sure if I'm saying it right, saying it would take over at least a year and more resources than they had to actually convert to their own currency, to go back to the drachma. That they didn't have the logistical ability to create a new currency. And he referenced Iraq. He said Iraq, they needed 27 47s and 1,000 trucks and the U.S. military to create a new currency and install it, and it took them about a year, in a country. And he said we don't have that ability. So to me, it's just amazing they've been sitting on the sidelines, not developing that plan. I think that's what they have to do eventually. I think the latest plan is going to fall apart. But as Janet Yellen would say, it's not that big of a deal. For example, for the U.S. economy, I don't think, except as a warning of something that we, in the long run, that we need to be careful about.
Okay, that's it. That was
All right,
great.
thank you guys.